In early 2020, the US stock market fell faster than it did during the Great Depression. It took just 16 trading days for the S&P 500 to drop from an all-time high into a full-blown bear market, the fastest crash of its kind ever recorded. And here's the strange part, the people who came out of it ahead weren't the geniuses who saw it coming or called the bottom. They were the ones doing the single most boring thing in all of finance. That boring thing has a clunky name, dollar cost averaging, and by the end of this video you'll understand exactly why it quietly beat the panic. So let's start with what dollar cost averaging actually means in plain English. It just means investing a fixed amount of money on a fixed schedule, say $200 on the first of every month, no matter what the market is doing that day. You don't wait for a dip, you don't wait for good news, you don't try to guess whether today is a smart day to buy. You just keep showing up with the same amount over and over, like clockwork. Here's the analogy that makes it click. Imagine you fill your car with exactly $40 of gas every single week instead of buying a set number of liters. When gas is expensive, your $40 buys fewer liters. When gas is cheap, that same $40 buys more. You never have to be clever about it. You automatically buy less when it's pricey and more when it's cheap, just by keeping the dollar amount fixed. Dollar cost averaging does the exact same thing with shares of the market. When prices are high, your fixed payment quietly buys fewer shares, and when prices crash, that same payment scoops up a whole lot more. And it turns out a crash is the one time that automatic behavior really earns its keep. To see why, let's watch a real crash happen, the big, fast one from 2020. On February 19, 2020, the S&P 500 closed at a record high of 3,386. Life was normal, the market was calm, and nobody watching that green line had any idea what was 2 weeks away. Then COVID hit the headlines, and the market did something it had never done this quickly before. In just 16 trading days, by the close on March 12, the S&P had fallen more than 20% from that peak, the fastest an American bull market has ever tipped into a bear market. And it didn't stop there. By March 23, only about a month after the record high, the index bottomed out down 33.9%, a third of the entire stock market, gone in roughly 5 weeks. This is the moment that tests every investor's nerve, and it's where most people do the worst possible thing. They panic and sell at the bottom. But watch what the boring dollar cost averaging investor was doing this whole time. While the line was falling off a cliff, they weren't watching the news and sweating, they were just making their normal monthly purchase. Their fixed payment in March bought them far more shares than the same payment did back in February, because each share was suddenly on sale. Those cheap March shares turned out to matter enormously, because of what the market did next. Instead of staying down for years like it did after 2008, this crash reversed almost as fast as it fell. By August 18, 2020, about 6 months after the peak, the S&P 500 closed at a brand new record high, ending the shortest bear market in history. So the person who kept calmly buying through the scariest month of the decade didn't just survive it, they'd stocked up on cheap shares right before the fastest rebound anyone had ever seen. Let's put real numbers on that with 2 investors, each with the same $6,000 to put into the market in 2020. Meet Investor A, the market timer. Investor A waited for the right moment, felt confident when everything looked great, and finally went all in with the full $6,000 on February 19th, the exact day of the record high. At that price, $6,000 bought Investor A about 1.77 shares of the index. Now meet Investor B, the boring one. Investor B didn't try to pick a moment at all. They just invested $1,000 on the first trading day of each month, from January through June. That means Investor B kept buying straight through the crash, $1,000 in February near the top, but also $1,000 in April, when the index was down around 27% and shares were cheap. Because those later payments bought shares on sale, Investor B ended up with about 2.02 shares for the very same $6,000. So let's jump to the end of the year, December 31st, 2020, when the S&P closed at 3,756. Investor A, who bought everything at the peak, was worth about $6,655, a gain, but a modest one. Investor B, who calmly spread it out, was worth about $7,601. Same $6,000 invested, same year, an investor became out roughly $945 ahead, about 14% more, without ever once trying to be brave or smart about timing. Now, one honest note, because this matters, Investor A only lost this race because they happened to go all in on the single most expensive day of the entire year. On a normal day, which is almost every day, putting your money in all at once actually tends to win, and we'll get to exactly why in a second. The point of this example isn't that dollar cost averaging always wins, it's that it protects you from the one nightmare Investor A walked straight into. So let's clear up the biggest myth about dollar cost averaging, because getting this wrong is how people get disappointed. Dollar cost averaging is not a magic trick that squeezes extra returns out of the market. In fact, Vanguard studied this across decades of market history, and they found that investing a lump sum all at once actually beat dollar cost averaging about 2/3 of the time. The reason is almost boringly simple. Markets go up more often than they go down, so on average, money that's sitting on the sidelines waiting to be invested is just missing out on gains. So if it usually loses on returns, why is dollar cost averaging the strategy everyone recommends to beginners? Because its real job was never about maximizing returns, it's about managing your behavior and your nerves. It quietly protects you from two very human disasters: dumping all your money in right before a crash and panic selling everything at the bottom once the crash arrives. Think of it less like a performance booster and more like insurance. You trade a little expected return for a lot less regret and a much better chance you actually stay invested. And staying invested, calmly, for years, is the thing that actually builds wealth far more than any clever timing ever will. So here's the whole idea in one line: you can't reliably time the market, but you can out-consistency it. Fixed amount, fixed schedule, ignore the headlines. That's dollar cost averaging, and its superpower is keeping you calm and invested when everyone else is losing their minds. You saw it in one real story, the fastest crash in history, where the boring investor turned a terrifying month into a discount rack. And the best part is you might already be doing this without realizing it. Every paycheck that automatically buys into your retirement plan is dollar cost averaging on autopilot. Quick reminder, though, this is educational only, not financial advice, and past performance never guarantees the future. If watching a chart fall 33% made your stomach drop, here's a question worth sitting with: who decides when money gets cheap or expensive in the first place? Next time, we're going after the single most powerful number in your financial life, the interest rate the Federal Reserve sets, and how those few people quietly move your mortgage, your credit card, and your savings account. Subscribe so you don't miss it, and go be boring with your money.